And we do the standard thing, the whole risk disclosure thing. So obviously trading involves risk. This is education. Check with the financial advisor before making any decisions. Read our disclaimer on our website, et cetera, et cetera. I want to remind you, this is about strategy. We teach about strategy, system, and style. So with system, we have the 12-step trading system and the one pattern for all markets. Style is going to be where we go into diagnostic trading. We talk about a lot of details about how to actually analyze and look and read at the read the markets. And then strategy is what it is basically the details of understanding a strategy. It's the book of Hoyle on the different games of the market, such as stocks or ETFs or futures or Forex. If you haven't done so, make sure that you do watch the 12-step trading system video. And what we're going to cover today is we're going to go over what's an exchange. We're going to go over some of the different exchanges throughout the world. We're going to talk about what is a stock, what's an ETF, how to trade short in a retirement account. We're going to talk about 4 different types of stock margin. And we're going to go into top-down analysis and quickly finding industries and sectors of stocks and how to trade a stock. All right. So with that in mind, what's an exchange? Well, we already talked about this on the last one, but an exchange is where buyers and sellers come together to place orders. So market makers help facilitate that process, and that's sort of what moves the market back and forth as they're trying to facilitate, filling those orders. And that's a universal location. And then, of course, they get fees and things like that for providing that service. And there's exchanges that are throughout the world. You probably know about, New York Stock Exchange, maybe the American Stock Exchange. You definitely heard of NASDAQ. There are a lot of stock exchanges. These are the stock exchanges just in the U.S. I'm going to post all these, on the website in the forum for you so you can check them out later. And I even have the links to the exchanges for you. In addition, here's ones in Canada. There's ones in Mexico. You have Australia, Belgium, France, Germany, Italy, Netherlands, Spain, Sweden, Switzerland, the United Kingdom, and in Asia, you got Australia, Asia Pacific, Asia, Australia, Hong Kong, Japan, and Singapore. So, literally there's just a ton of them throughout the world that you can pick from. In the U.S. alone, there are over 20,000 stocks just on the New York Stock Exchange, the American Stock Exchange, and the NASDAQ. So there's a lot to pick from. Unlike futures, you have a lot less variety, which makes it a little easier. On stocks, there's constantly new stocks coming in and going out, and of course you have stocks that have been around for a while. A stock basically is just a piece of the pie. If you have an apple pie, and you cut it into 10 slices, you have 1 share of stock in apple pie. So if you have Apple Company, and cut it into 1,000,000 slices, you have 1 share of stock in Apple. You actually have a share of ownership in the company. And shareholders have different benefits and rights depending upon how many shares they own. If you own a share of stock that pays a dividend, then you can actually get a dividend payment made to you. And if you ever want to check out what the dividend payouts are and when you have to own the stock to get the dividend, just go to earnings.com. It has all their scheduled earning releases, dividend releases, dates that you have to own it. Everything is on there. If you have any questions about that or how that works, just let us know in the forum. ETFs, they're like a mutual fund and a stock combined. So to explain that, just to go over, a mutual fund is where a bunch of money goes to one place into one fund. And that money is then, totaled at the end of the day, less any fees divided by any assets that are in there, and then basically a share price is determined. Okay? So they put all the money in, they trade various things, and then they come up with how much money we have left at the end of the day, let's divide it by everybody. And that's where they come up with their price. And then, now understand, a mutual fund can only be bought or sold at the end of day price. Now, you may have to turn your order by 12 noon, but you're going to get the end of day price only. If you turn it in after your broker's cutoff time, then you're going to get the following day's price. An ETF is a fund where assets are pooled to track something, but they can be bought or sold throughout the day, just like a stock. And it's a way to basically trade a basket of stocks, or diversify different stocks, or maybe even trade different commodities, things like that. And you don't have to worry about, just like a stock crashing and dragging down, your entire portfolio. It may just affect the ETF some, but it won't be like the stock, like Enron going to zero. So the ETF won't go to zero, to just make it hurt depending on how much of Enron that ETF has in it. Okay? And obviously that's, an old example. I just want to provide that, as an easy scenario that everybody would understand. So to look at a few ETFs, people are really interested in ETFs, and I think they're a great way to trade because you don't have to worry about that, that risk of just a single stock. You have the SPY that tracks the S&P 500 futures, so that's how you trade the market. The diamonds, DIA, SPY is also called spiders. Okay, DIA is diamonds, and that tracks the Dow Jones 30 or the Qs. And depending on your broker, it's either QQQ or QQQQ. So there's 4 or 3 Qs. Most brokers have now updated to have 3 Qs for the symbol, and that's the NASDAQ 100 stocks. Okay, so it's basically the top 100 stocks in the NASDAQ. That's a very easy way to trade a basket of stocks. And then, there's ones that, energy, Oil service, oil, technology. There's literally just emerging markets, a lot of different ways to trade ETFs, even silver and gold ETFs. Plus, you can trade currencies using ETFs. We talked about currencies before. So a way to trade currencies. Here's a whole bunch of ETF currencies. The issue is currencies move overnight. So it's very hard to have stop losses and take profits when something literally is moving, basically 24 hours a day. And there's constantly new currency ETFs that are coming up. And then there's what's called leveraged ETFs. And they're supposedly supposed to track something and go 2 to 3 times as fast. So, for instance, if you had one of the ones on here says, real estate bull 3 times. So basically, if the REIT market's going up, it should go up 3 times as fast. Now, they rarely track everything to the exact multiple, but they're basically they're meant to be a lot faster. So they move more. So you're going to get more volatility in them. So if you're with something that moves a little bit more, then you could use a leveraged ETF. And some ETFs have been known to literally go from like $35 or $40 up to like $300 in a matter of days when there's been a big move. So it's definitely an interesting way to trade the market. And there are a lot of them. So ultra gold is supposed to go twice as fast as gold. So you always want to check it out and see, is it really moving, at that speed to make it worth it. And there's treasury ones, and you can even trade treasuries this way. And there's international ETFs. So if you want to get into international markets, this is a way to do that with ETFs. You can trade it throughout the day without having to research 1,000 different stocks. It really can narrow down your choices. And I'll post again all these online for you. And there's, like I said, there's ultra international ETFs. There's ultra currency ETFs. And one of the things you can do with ETFs that's really cool is, if you have a retirement account like an IRA, you can actually trade short. And so, to look at that, we're going to look at some short ETFs. Also, you can do options, certain types of option strategies, and we'll talk about those in one of the upcoming modules when we go into options. But let's look at a few short ETFs. So, like short QQQ, like the market, or short S&P 500, SH. If the market is going down, then buying SH would go up because it's inverse. It's going to go the opposite direction of the S&P 500. So, here's a way to trade a bunch of the indexes with inverse, and there's even ultra, which means like usually 2 times the speed ETFs as well that you can trade. And here's just an example of some of those ultra shorts. So they ought to go down twice as fast when the market goes down. And here's a few more examples for you in different sectors, okay, in industries, and some international markets that you can use. So if a market major issues going on, this would be a good way to do that. You hear some bad news about a country, you find a short ETF. That's a way to make that trade, okay. And then there's even triple leveraged short ETFs. So, you can use, again, that's just more speed, faster moving things. So if something's crashing, this ought to fly up 3 times as fast, is the idea. Okay? And that's just another way. A lot of people don't know about those, and, they can take advantage of them. So now let's go into margin. Margin is the amount of money you have to put up to make a trade. Most people, don't even know about margin, unless they become, a little more active investors and traders. There's cash margin, which is if stock costs $100, you have to put up $100 to make the trade. Okay, so on Reg-T Margin, if it costs $100, you only have to put up $50. Most accounts nowadays, when you sign up, you get Reg-T Margin. So when you buy a stock, they usually put up 50% of the money. Okay, and you're sort of borrowing the other 50% from your account balance. All right. Day trading margin is basically they multiply that for. We're going to talk about how that works, but that's for day traders. And you have to have at least 25 grand in your account to be a day trader. And portfolio margin is risk-based margin. And it's the best margin in the sense of it gives you the most buying power, has a few more rules with it, and you have to have at least 100 grand or more in your account to get access to portfolio margin because there's more risk, and they want to make sure that, basically they think that more money means more astute investor. That doesn't necessarily mean the case, but that's how the rules are built. So, again, just to, go back to Reg-T Margin for you again real quick, because that's what most people are going to use. Is if I have a stock and it costs $100, then I only have to put up $50 to buy it. So I have $50 remaining in buying power that I can use. But if I lose more than the available liquidatable, like basically the cash I can pull out. So if I have $10,000 and I buy $5,000 worth, or I buy 10 grand worth of stock and I only have to put up $5,000, I have $5,000 of cash I could pull out. Well, if that amount ever gets to zero, okay. And sometimes if it gets like to 10 or 20%, depending on the broker, but let's just say when that amount gets to zero, they're going to sell out all your positions. It's called a margin call. All right. So, because, basically they don't want you to lose more. So that's why they set that money aside. Margin means we're going to take this money and set it aside to let you do the trade. And we're setting that aside in case you lose money to make sure you still have money in your account. That's the idea of margin. Okay, it doesn't guarantee you of anything, but it's the broker's way of making sure you don't owe them because they owe the exchange when they let you trade. Okay, so they have to ante up if you don't, and they don't like that. And that's the whole point of margin. So day trading margin, you have to have at least 25 grand in your account at all times. If it drops below that for a minute, then, they're going to call you and say, hey, get it back above there right now and don't go down below that again. Okay, some brokers may require you have more money in there, and they can literally give you like 4 times the margin requirement buying power. So if a stock costs $100 and normally the margin is 50, they could literally let you buy 4 shares for $50. Okay, so obviously you can see how that can really multiply your buying power, and that trades are going to open and close on the same day, really within the same week. Okay, if you ever trade more than 4 open and close trades that entry and exit happen within a 5-day period, you'll be flagged as a day trader on stock and ETFs. There are no day trading margins on Forex or futures or binaries, and we're going to talk about those. Or we've already talked about Forex and futures. We're going to talk about binaries and things that you can use in place of that to day trade with a much smaller account. But for stocks, you have to have 25 grand in there to do stocks or even stock or ETF options. Okay. If it does happen, then you're going to be bumped immediately to Reg-T Margin if you drop below 25 grand. So if you had 27,000 in there, if you lose 2 grand or $2,001, then they're going to be like, hey, get it back above 25. They give you 5 days to do that. They leave you on Reg-T Margin, and then if you don't meet it by the 5th business day, they're going to move you to cash margin for 90 days or until you bring it back up to 25,000. Okay. You can go and request, and you're like, I'm not going to day trade anymore. You can call your broker and tell them. Usually they'll give you Reg-T Margin, but they won't let you go back to day trading margin again for 90 days. So all these are sort of general guidelines, and the regulations could always change based on the broker. But you can always call your broker and say, hey, what are the day trading rules, and how much do I get? What's my buying power, and things like that, and they'll go over the details with you. And then portfolio margin. Portfolio margin is sort of like, if you have quite a bit of cash, this is really the ultimate way to go. It gives you the most buying power. Doesn't mean you need to increase your risk, but sometimes you could have a small risk on a really expensive product. So maybe your risk is only $100, but the thing costs $5,000. Okay, so you don't want to have to put up $5,000 to risk $100. So that's sort of the idea with portfolio margin is keep your risk the same, but let you do multiple trades, so you're not tying up your entire account in one trade. And some brokers may require 150, some may require 250, so you have to shop around to find the right one. Most of them that I've talked to now, they're usually requiring about 125. 100,000 is the minimum they're allowed to give you portfolio margin with. And what portfolio margin means is that you only have to put up the risk in the trade or percent move in the underlying. So if you buy a stock that costs $100 and it moves up or down 15%, that'd be a $15 move. So they'd only make you put up $15. That's basically a one-day move. They expect a 15% move to be the largest move it's going to make. Now, if it moves 15%, they're going to keep. You're going to be down $15 plus. They're going to keep holding on to that 15%. Okay. So it's not like that means that that's all you're going to lose. That just means that's all they're going to require you to put up, and then you're still going to have your P&L fluctuation. Now, leveraged ETF, like the ultra, longs and shorts we talked about, they can require a margin of 2 times the 15% or 3 times the 15% for a triple leveraged ETF. So they do require more margin on portfolio margining. And, now here's another example for you. Remember I said risk or percentage. Well, let's say you buy a $100 stock and you buy what's called a $100 strike put for $5. If you don't know what that means, don't worry. We're going to cover that soon on the options. But if you do, just to go over this and make sure you get it, a $5 strike put means that I have the right to sell the stock at $5. A $5 strike put means I have the right to sell the stock at $100, and the premium I pay for that is $5. So if the stock drops to $50, I can still sell it out for $100, and I only lost my, I didn't lose my $50 because I sold it at $100, but I did lose my $5. And again, we'll go over that more on options next week, and we'll really break it down for you. But $5 is the max risk, therefore $5 is all I have to put up to buy the $100 stock. Okay. So that's portfolio margin, risk or a 15% move or greater if it's like an ultra leveraged ETF. And then some brokers actually will require you to take an options test before they give you access to portfolio margin because they want to make sure you know how options work and the risk works so you don't over margin yourself. And there's no guarantee, but at least they've done some due diligence up front to try to make sure that you're not incorrectly using portfolio margining. A lot of brokers don't require it. So You ought to know quite a bit from our options test to be able to cover that. But if you have questions about portfolio margining, just let us know. The next thing is margin interest, and this is really important that you understand this. Let's say you have 200 grand in your account, and you buy $300,000 worth of stock, and so for that 15% move, you'd have to put up 45 grand. So now you have let's see here. Let me fix it. So you have 200,000 in your account. You had to put up 45 grand, okay? So you have $155,000 left that you could withdraw, okay, from your account. So, and that's your actual equity, okay, your true, like, dollars that you can pull out, not including shares. So, or that's your tradable equity, money you can move around and do things with. Well, if you hold the position overnight, then you're borrowing money, right? Because if you have 300 grand, okay, of stock, and you have a $200,000 account, then you're actually borrowing 100 grand. Okay? It doesn't mean like you have payments and everything on it, but since you're borrowing it, there is interest. Okay? So anytime you use margin that is greater than your balance, then they're going to charge you interest on your account overnight. And, you want to be really aware of that because, that interest could be high. It could be like 8% a year or something. So just depending upon who the broker is and what they charge you. There is a really advanced technique called box options you can use to increase the cash balance in your account. But it needs to be for somebody who really understands options, really understands margin, and really understands buying power. And if you want to know more about it, then I can answer questions for you in the forum. But just let me know. So if there's anybody that's looking to use box options to increase their cash. Now you can't withdraw the cash. It's just it increases your cash, so you're not borrowing it from the broker. Anyway, so just understand that if you borrow more than's in your account, you got to pay interest on the amount you're borrowing until you close the position. Okay. Now let's go into top-down analysis. So a real simple way is go to finance.yahoo.com and type in a symbol, like Apple or whatever. Click on the profile, and on the profile you'll see a lot of things. But one of the things you can see like index membership, sector, and industry, things like that. Also, there's a section called components right under profile there that will let you see what ETFs the stock trades in. So if you want to trade an ETF instead of a stock, that's an easy way to go. You know what? I like Apple, but I don't want to trade just a stock. I want to, sort of a basket, a little bit, diversified. I want to go to an ETF. That's the easy way to find an ETF that stock is in. Okay. And like I said, you can check out the index it's in. So you can check the chart on the index by clicking on like right there where it says NASDAQ 100 to see, how it's performing. You can click on the sector to see what industries are in that sector, and then you can actually look at the industry to see other stocks in that industry. So like Apple and Dell and IBM, stuff like that for like personal computers or something like that. And you can see a chart of how well that sector is performing. Okay. You could also look at the ETFs and see how the ETFs that stock is in are performing. So if you look at the index and you look at the industry and you look at the ETFs and all of them are going down, but your stock's getting a long signal, you might want to rethink whether or not you want to take that. So these are all things. Top-down analysis is looking at the top, like the index, down to the industry, down to the ETF, and to sort of see an overall, before I finalize my decision on whether or not this is a stock I want to choose, because remember, you have tens of thousands of choices, worldwide, and then, over 20,000 just in the U.S., which, stock do I want to trade? And so you don't want to trade a stock that just is completely going against the industry and against the index and stuff like that. You want ones that are, working within their industry and their index, because stocks tend to move together. Okay? So when the market goes down, most stocks go down. So if you're trading a stock and you're trying to go long when the market's going down, then you're sort of fighting an uphill battle. Okay? And that's what top-down analysis is. And that's how you easily find it. So, you can go in and, find the direction of the index, find the direction of the sector. Also check, there's a section where it says news and info. See if there's any upcoming news announcements that are important. Are there any company events like earnings announcements coming up? Because that can definitely move a stock, and it does it a lot of times overnight. So you could have a gap that could mess you up. So you want to know if there's an earnings announcement, because you might not want to be in, depending upon the strategy that you're using, and then and the system and the rules that you have. And then you can check out the ownership. You can see if like CFOs and CEOs are selling or buying the stock, the insider trading. You can also look at financials. When you look at financials, you don't have to look at all the details, okay? But income statement is very important. Look at the gross profit, net profit, year after year and quarter after quarter. Is the company growing? If they're not growing, then why would the value of the stock go up? Okay? Or if they are going, if it's going down, then hey, well maybe that lines up with shorting a stock. So that is sort of some basic fundamentals you can look at without getting like overwhelmed in fundamentals. Again, this is part of top-down analysis. This is more if you want to own a stock for a long period of time. Okay, if you're day trading, like the income statements, the insider trading, not near as important. News and company events, it's good to be aware of those. Looking at the sector and the industry, that can be good for day trading, just to sort of see how they're doing the day. So that, because usually they all move together. And then let's see here, a couple other things to go over is, do they all line up? Does everything say it's going up or going down? And then, for determining your entry price, your exit price, your stop loss, your take profit, everything, that's where the one pattern for all markets comes in. Okay? And like I said, you can even use this on, day trading. Some stock charts that you could use and look at. Your broker, obviously, ought to provide stock charts for you. You can go to freestockcharts.com, stockcharts.com, bigcharts.com, finance.yahoo.com, google.com/finance, wikiinvest.com. Those are all good free ones. They're going to be delayed unless it's your broker. You'll get delayed data feeds. I highly recommend TradeStation for stock trading. One of the reasons is because they have a very, very fast stock backtest trader. So you can go in and you can put in the one pattern for all markets and you could easily test it. Now we're going to talk about the good and the bad of backtesting because it doesn't account for things like earnings announcements and, if the sector's doing good or bad and stuff like that. But, it's really good if you want to test out, especially shorter term strategies, things like that. TradeStation is great. It's fast. It's easy to use. I know guys that make a lot of money that use TradeStation. They love TradeStation. Another, good free platform, you can get NinjaTrader.com for free. You can get Kinetic.com, end of day data for free and plug it into NinjaTrader. They don't really let you do any kind of historical backtesting stuff with stocks. But you can at least, look forward, and you can also look at the patterns backward and pull the charts up and, throw indicators and things like that on there. And it's very powerful. It's very good. Our software plugs into NinjaTrader and TradeStation. So both of those are great. And we'll talk more about the the software and stuff later. But right now, these are some areas you can go to look at stock charts if you want to. And how to trade stocks and ETFs. So one pattern for all markets, just a quick review. So you got the A bar, you have the P bar, and then you'll get your entry right here. And so one tick above, in this case 1 cent, right? Because we're trading stocks. Now stocks will be quoted usually in the currency of the country that they're in. So they'll be quoted in Aussies. Here they're quoted in dollars. So in Mexico they'll be quoted in pesos. Okay, so 1 cent for U.S. stocks. Above the P bar is where you get in on both entries. So in your profit popper and your trend catcher, then you take your profit popper, just 1 pip, cent tick. In this case cents, below the A bar, and then you'll move your stop loss. Remember, because you had your stop loss like 1 cent below the P bar for both your profit popper and your trend catcher. Once your profit popper takes profit, you cancel the order here, and then you move the order up here. Okay, and we'll talk about orders like good till cancel, market and limit, and all that when we go over to platforms. But that's how you would do the strategy, literally right there. And then once it completes the X, then you have your completed apex. Okay. And then you'd repeat the process as it keeps going. So this is cool because, when did Google get too expensive? 50, 80, 100, 200, So this allows you to get in on trends in progress, and you just keep repeating it. And even if this has happened, you can join in on the next one. And then, of course, don't forget that you're going to want to move your break even on trend catcher up to 1 tick below the next power line after you get the apex. So that's how you start trailing your stop. Okay, so if you haven't watched it, make sure to watch the One Pattern for All Markets video.